Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business developments, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. Now, it could be worrying or good news. Bank lending is going up, but mostly in the personal loans segment, especially housing and also Mudra. However, within personal loans, it is the credit card loan segment that is rising rapidly, obviously reflecting a rise in consumer indebtedness. Moreover, household debt as measured by credit outstanding per credit card in India has been rising both in nominal and real terms. Total outstanding per credit card stood at 8,668, a rise of 16% almost year on year, according to a report put out by the State Bank of India. Now, while indebtedness is not a bad thing, rising levels can be worrying or at the least deserve pondering over, particularly if industrial credit is not rising too. Now, what does this reflect about the state of economy in general and overall consumer sentiment at this point, assuming we can take this as a signal of sorts? What are the other headwinds and tailwinds that can drive or will drive domestic demand in the country at this point? To discuss this, I'm joined by Dr. Soumya Ghosh, Chief Economist of the State Bank of India, and Dipankar, Mitra, also an economist. Thank you both for joining us. Soumya, let me start with you. It's a very interesting and worrying report that your desk has put out. So one is, you're saying that indebtedness is rising. That itself is not the concern in as much as the fact that indebtedness is rising, while as industrial credit, which usually leads such credit, is not rising. Am I right?
Yes, absolutely. So I think the basic problem, I think there is, you have exactly hit the nail on the head. The point is, what we are trying to put out over here is that bank credit growth, absolutely per se growth is not the problem. The issue is with the composition of the credit growth. As of now, what is happening is that there are actually two components of bank credit, the industrial credit and the retail credit, which typically is the personal loan, the home loans, the credit card and all those things. Now, what has been happening now is that there has been a rapid increase in the personal loan segment, but industrial loan, the credit to the industry has not been rising. In fact, most of the credit to the industry is actually refinancing or basically trying redistribution of the pie. And if that is the case, and as we have seen that I mean, even though right now the situation is actually not comparable, before 2008 there was a significant increase in the personal credit before it started to decline after 2008. Now we are again in a similar situation where we are seeing a continuous increase in the consumer indebtedness, and the other worrying factor is in real terms. The consumer debt is actually increasing. So whenever it increases in real terms, that's always a matter for worry, because if the interest is actually stays at a higher period for a longer period of time, the real terms the debt goes up, and that actually could lead to a problem on the consumer balance sheets. So as of now,
you say the average outstanding is about 8,600
yes.
rupees. Now, what does this average reflect? Is this an average of all credit card holders and then outstanding loans divided by that total number?
Exactly. So that's basically the average one, and the point is over here is that as long as you have the capacity to pay, that's not an issue, but it continuously goes up in real terms, and as you just pointed out, as per our report, it has gone up by close to 20% over the last 2 years. So that's a matter of worry, and if interest rates are at high period for a long period of time, that could cause a lot amount of distress to the consumers.
Would you put this in the context of the number of credit cards in India and the total outstanding vis-a-vis overall consumer or personal loans?
Exactly. I will give you another data over here. I think the Indian context, the problem is that the debit card holders are actually not spending. So if you look into the debit card data, actually the spending per card is declining over a point of time. But if you look at the credit card data, that data is increasing over a point of time. So what does that mean? This means that the consumer is not spending from his pocket, but actually they are trying to spend on the basis of borrowed money. So per se borrowed money spending is not bad, because there is a lot of e-commerce transactions going through as of now, so that should actually reflect that state. But as long as that is within the budget of the consumer, we don't have an issue. But if it goes on like this, increasing for a longer period of time, as we have seen prior to 2008, that could always create a problem on the consumer balance sheet.
Okay, hold your thought there, Soumya. So Dipankar, what's your sense? I mean, what is your reading of consumer demand at this point of time in the context of other macro indicators that we've been talking about?
I think it is an interesting data point which has been highlighted by Dr. Ghosh. But the starting point to look at it would be the fact that the credit penetration in India is very low. And since FY12, when the cyclical downturn came, it made enormous sense for the banks to shift their portfolio from the corporate credit to the personal loan book. So, to a large extent, I think this is a push from the supply side, where the banks at present, those banks who have been traditionally strong to maintain a retail book, they are pushing it more aggressively. Those who didn't have that big a base have also started lending.
Somewhat similar to what we saw in 2003-04?
Yes, it is. At that time, we possibly started the phenomena of retail lending in India. I mean, we barely have a history of 2 decades at the max of retail lending of any kind.
Right. So, what you're saying is that this is really a rebound in some ways, for good or bad.
This is on the back of a structural trend whereby the credit penetration is very low, and banks sort of are willing to seize that cyclical opportunity, which comes on the backdrop of this low credit penetration, and they have very smartly reoriented their portfolio.
So that's the reason why it's happening. So what about the impact itself? How do you read the 8,600 figure?
As of now, I would view it as an opportunity more rather than a threat, and possibly there is still some distance to go for the banks to exploit this opportunity.
Reaching number of people or the number of others?
Both.
Or the size of the...
Even as the size of the average credit. You see, at 8,000 rupees, it is, if you compare it with the per capita income of the country, at the very macro level, it doesn't really sort of
$1,500
worry us.
So,
Yes, but the point that Dr. Ghosh was mentioning, that at pockets it could be a problem. So, if the credit card lending is showing very sudden increase, we will have to see whether the banks have pushed it too hard to reach to even the not so
the levels that
credit.
we've reached today.
Correct.
Right. Okay. So let's look at the other side now. The report also points out that industrial credit has been slow, and that's really causing the concern. Usually, industrial credit leads this, but in this case, it's lagging it, if at all.
Absolutely.
So how do we read that?
I think that is the real concern. The fact that the retail lending part, say, has increased by a couple of percentage point doesn't worry me as much as the fact that the banks are not able to lend to the corporates because of a cyclical downturn, and secondly because of the bank's own unwillingness to lend to them because they're still dealing with the NPA problem. So the question that I think is more relevant here is how long this NPA cycle is going to take to rebound, and what are the kind of policy response we can come up with to help that situation.
Right. So that's interesting. So Soumya, if I can come back to you now. So Dipankar says this is a supply-led push.
See, I just want to add one point to what the point which Dipankar just mentioned. I think if you look into the per capita, nominal per capita income in India, if I am not correct, that is around 70,000 odd. Now, in nominal terms, the credit card outstanding, as you mentioned, as we have the data as of February, it was 8,968. So that means if you annualize it, it is close to 1 lakh. So even at that level, I think it's higher than the per capita income of the country. So that's the first point. The second point is that yes, I do also agree that as of now, the credit card or the debit card, whatever way, if you look into it, even though that is not a big issue, but as long as this industrial credit doesn't grow, that is going to create a significant problem on the bank book, because at the end of the day, if the industry doesn't grow and if the consumer credit goes, that means it is not sustainable, and that's why it is leading to an increase in the consumer indebtedness and not the consumers, and the credit card and the debit card spending is actually declining. So that's the point of concern over here.
So obviously debit card spending means people are relying less on cash and purely on credit. But Soumya, very quickly, is this also a secular shift in consumer behavior, or could it be that?
It could be a secular shift in consumer behavior, but the other thing is that if there was a secular shift in consumer behavior, the consumer should also be spending from debit cards, but they are actually not doing that. So that also, I mean, which is possibly a story which is beyond the scope of the discussion of this topic, is that the cash is also increasing with the people at hand. So that could be another way of looking into the thing. So I agree with the fact that there could be some structural shift, but the structural shift should entail that both credit card and debit card should increase, rather than one part increasing than the other part declining.
Right. Okay. So Dipankar, I mean, let's look at now what we should be doing, if at all we should be doing from a policy perspective.
Right. I think at the banks level, they should come out with board mandated prudential limits of how much they should be advancing to credit for the credit card, etc. And I think as the All India Data and Investment Survey results have thrown.
But can you do that? I mean, can you actually fix a limit for credit card? Because once you give a credit card, you set individual limits and then people spend, don't you?
Yeah, but in setting those limits, you can have prudential judgments.
Okay.
So you can draw your lines about the segment of the population which is not so credit worthy, and you can exclude them. And I think that will be roughly 10% of the rural population and maybe 20% of the urban population, as the All India Data and Investment Survey says. So that would be the first check of
so slow down the supply push. That's what you're saying.
Right.
Yeah.
Or limit it to only the credit worthy people. And second layer could be that from the regulator side, that examine what are these individual prudential norms that the banks have worked out and following. And secondly, another phenomena which we have seen, that the number of complaints are unusually high for the credit cards. Now that would require two-stage intervention. I think on the one hand, you will have to increase the financial literacy a great deal, because many people would not know the implicit interest rate charged on their credit card outstanding, etc., which eventually builds on, and then you have people coming with a lot of grievances on that count. So financial literacy is one intervention which the regulator can do. Secondly, of course, checking with the banks boards what are the internal norms that they have said, and based on that they can also prescribe certain macro regulations.
Right. So we need some intervention is what you're saying. Last word, Soumya, what should be the policy way forward in this context?
No, I think as of now there is not a cause for worry, because if you ask me, Govind, personally, before 2008 we had just calculated what was the total amount of credit card outstanding in total retail loans. That was around close to 5%. So right now it is less than 3%. So I think there is not much to worry at this point, but my only point is that the interest rates staying higher for a longer period of time actually hurts also the people in terms of the real terms of the debt, and that has gone up significantly. So that's the cause for worry as of today. And regarding the prudential limits which the Dipankar was talking about, I think it may be a difficult thing to do at the micro level or the bank level, because the credit card limit is linked to the credit worthiness of a particular individual. And at the end of the day, I mean, there is a huge retail market in India, and I think there is already a prescription by the RBI that you cannot, the total outstanding credit of the banks to stock market, to sensitive sectors like stock market, cannot be 5% more than that. So on the top of that, if you just put a restriction on the credit card, that means it may not work out.
Well, gentlemen, we need to go in for a break, but coming up on the other side, we talk about exports, where the grim news continues, now declining for the 16th consecutive month. Stay with us. Welcome back to Policy Watch. It's another month of grim news from India's export sector, declining for the 16th straight month in March to $22 billion. Exports for the year ended March stood at $261 billion, almost 16% down from last year. More and more sectors, including engineering and petroleum products, are showing sharp declines now. Now, while these declines are in step with major economies around the world, including the US and China, both of which have fallen 11% in the last year, the question is, could India be hurting more because of these export declines, particularly in the context of India's domestic economy, which is yet to gather speed beyond the current projected levels? And if so, what needs to be done from a policy and industry perspective? To discuss this, I'm joined by Ashwin, Savani, President of the All India Exporters Chamber, Sujan, Hajra, Chief Economist and Executive Director at Anand, Rathi, and Prem, Malik, immediate past Chairman of the Confederation of Indian Textile Industry. Thank you all for joining us. So, Mr. Malik, let me begin with you. Now, are we seeing a record of sorts in terms of the way exports are declining in the context of at least post-liberalization India?
I think this first time for last many years that we are seeing for the 16 consecutive month decline, and that also a very sharp decline. It's not a marginal decline that is taking place. Of course, there are factors why this is happening. Primarily is that the entire, if you look at the entire globe, barring probably the US, which is growing but not very significantly. That's the only exception. The rest, whether you go to Europe, this is in trouble. And there are various reasons. Today there are new areas have emerged like terrorism, you're talking refugee problem, your exit UK issue, you have various issues in the EU. In any case, some of the countries have not been doing well for the last couple of years. So EU is doing badly. The entire Gulf, because of the oil situation, where the prices have fallen, their economies have been affected badly. So overall, and the China also, which is the major hub of the activity in the world, has also started declining. This is the first time that you hear that the Chinese exports have fallen by 5%, which has never happened in the last many years. So there is a meltdown all over, which clearly says that there is a mismatch between demand and supply. So that's the reality. But of course, I think India is facing far more challenges than the other, because our figures are pretty large and they are not reducing month on month.
Right. So Ashwin, if I can get you in here, what according to you or from where you stand is the key reason for this decline, and is it now spreading across sectors and across verticals as opposed to earlier maybe where only one or two areas were looking relatively weak?
Well, in my opinion, the criteria is that the general economy of the world is moving downwards. Mr. Malik has referred to most of the issues, but fundamentally, if you look at the volatility of the money, our economy and everything, the value has dropped also partly because of the valuations of the money and the currencies. The realizations, the currency figures, the Chinese crashes in the stock exchanges, the drastic drop in oil prices, it is a cumulative effect, and technically every country is in its problem. Even China, as Mr. Malik says, is dropped irrespective of when it was. So it is not, I mean, the fundamental is that the exports have dropped, but I do not see it as a very negative point. Our thrust is going and our exports are going up. People are coming to us for exports. So the moment the economy improves, the way the policies improve in our country, of course, remedial measures are drastically required, but once those are done, I believe we should rise back in the next fiscal year or in this fiscal year. Towards the end of the year, our turnover should improve, provided the economies of the other countries improve. This is how I look at it. I do not see it as a negative factor. Exports drop, yes, but simultaneously our import bills are also dropping. Fuel prices have reduced our import costs also. So from that point of view, it's not a bad performance, it's a major drop, but I feel that it will go back quite well soon. This is my I'm an optimist in this field.
Sujan, let me come to you. So yes, it is a fact that imports are dropping as well, but not all imports, because electronics, for instance, is again continues to zoom and exports are declining. So should we take succor from the fact that the balance of trade and trade deficit is looking better in our favor, or should we be more concerned that it's exports which are declining and therefore the economic and maybe even social impact?
Obviously, the one big problem for India, we maintain a current account deficit. So to the extent imports are falling in tandem, if not more marked, in a more marked manner than exports. So the current account aspect of the problem is not emerging. But having said that, the impact on India is bigger because India is also one of the top exporter of petroleum products. In a sense, 80% of our crude requirements are imported. We just refine them and we export them. So from an average of $5.5 billion per month, our oil exports have gone down to about $2 billion. So that's also.
But most of this is two companies, or maybe
largely one company.
Reliance. Okay, no. So how does this affect the overall economy then? Because there's only one refinery which is in one corner of the country, importing and then exporting.
Yeah. See, the point is that we have lesser control on our imports. Because if you look at everything said and done, 1/3 of our imports are crude imports. We have a very sizable amount of imports like electronics, which are not otherwise domestically available. So the controlling typically controlling imports is counterintuitive. It impacts negatively on the economy. So the fact of the matter, our exports are not going up, or exports are declining for a 16-month in a go. That cannot be taken very lightly. But having said that, this is also important to understand that it's not so much a fall in volume, it's the realization, because given that the commodity prices have crashed and there is significant amount of excess capacity in the manufacturing sector.
Right.
So the unit price realization, fall in unit price realization has a much bigger role, as is reflected in the WPI in India.
Right. Which is still looking weak. Okay, right. So, Mr. Malik, let's look at what we need to do. As in, to what extent should we be worried?
Can I add one more point here? Two other colleagues have said it, but I think we should be little worried. Why? Because, in my opinion, the old model of trade as an instrument of growth is changing dramatically. That aspect, if we forget, I'm not talking of that's only gold or oil.
Sure.
But if you look at the rest of so what is happening is that more and more regional blocks are emerging. Preferential treatments are emerging. So what the people are doing, most of the countries are doing, they're trying to localize the entire thing, converting their raw material into the countries nearby, in the neighborhood, who are cheaper in conversion.
Right.
And thus, so overall there is going to be a shift in the trade unless India aligns itself. There is going to be a long haul before we can recover in a substantial way in our exports growth.
Right, and this has been discussed, but obviously there's not enough action on the ground. So aligning or creating a strong, effective regional bloc is one response to this situation. What else can we do?
See, basically what we need to do is that there are some quick fixes will need to be required. There are some which you need immediate turn, and some you need it on a short term, medium term to long term. So immediate turn, what we should try to see is that what is the exporters are suffering today. The one important thing is still the exporters are still exporting taxes. The all taxes are not being rebated, which means that the state taxes, the local taxes are not being rebated to the export. I think the government should align itself with the state government, try to come to a certain scheme of things where these can be, which means you become more competitive and thus you will be able to export more. That's one way of looking at it. The other is, there is also the currency issue. And government of also, there is a divergent of views, if you must have heard in the recent past. The RBI has one view, the Ministry of Commerce and Industry has another view.
As always.
Yeah. They have been saying let's tweak the currency so that it is depreciated and you become more competitive. RBI doesn't agree with that. No, that's one area where we can look at it.
Right. Okay.
The other is, if it is not within your hand, then you have the incentivization of the export for those sectors which need the most.
Right. Okay. Ashwin, let me get you in quickly before we run into the break. What in your mind should be a policy response, both short term and long term?
Short term, there are 2 or 3 aspects. We need to give a little more facility of credits and taxation to our exporters. We need to give them a better infrastructural backup. That is a long term process, but initially they need to be incentivized. But principally, till the world market improves, no matter what remedial features you look at, no matter what financial features you look at, interest is one factor, that is primary. We had given an offer of recovery of interest, it has not yet been done. So these issues are actually putting back the exporters, that they are not getting response from the places where they need immediately. And the second thing is, the world economy will have to improve for the boost. Every export country today is suffering. The point that was raised of the neighbor getting a better deal because of cost factor for conversion, it depends on the efficiency levels. If the exporters increase their efficiency, cost will go. China has done that. They have made their efficiency their cost factor, not the quantum. So if we improve our efficiencies of production, our cost of productions too can be competitive. So a concentrated and 3-pronged approach is required to get our exports in place. We need to improve internal efficiencies, we need to get better results from the government to boost our exports, and we need to see that the economy of the world, as it goes, we move in with their times and not lag behind and catch it up, because we have been good in our exports so far.
Got it. Okay. Last word, Sujan. So, if we were to look at this as from an impact point of view in India, what could be the impact? I mean, considering that the factors that will drive recovery, apart from the policy factors, will be largely external rather than internal.
Yeah, I think we have got, ironically, we have got the long-term fix before the short-term fix.
Okay.
The long-term fix is Make in India. And if you look at the kind of FDI flows which we are receiving, we received almost $60 billion last year. This year, first 2 months of the calendar year, we received about $11 billion. So the Make in India movement, in some sense, is actually progressing, and that's whether to reduce import reliance or to boost exports. This is our long-term move in the right direction.
Okay, but short-term impact?
So the short-term, the biggest thing, I think, procedural issues. Whether it's taxation, whether it's a free movement of goods. I think in that context, if GST comes into effect, a large part of this problem will get addressed.
Right. So, strive for internal efficiencies while we wait for other things to recover, including the global economy. We've run out of time, gentlemen. Thank you so much. That's all we have time for on Policy Watch this week. We'll be back next week, same time. Thanks for watching.